The administrators of the Tinubu administration are working hard to promote the relevance of the tax reform bill, but they keep ignoring the elephant in the room, the VAT sharing principle. They have made many people believe that state and local governments will receive money they do not deserve or that it should have gone to someone else. It is on the contrary. The good news is that the critical players and special interest groups have refused to be fooled into accepting the Greek gift. The northern governors opposed the bill too and urged members of the National Assembly to reject it. Similarly, in its last meeting, the National Economic Council recommended withdrawing the bill from the National Assembly. This shows the consequences of the proposed bill, which will affect everyone in the country, not just the North. The proposed sharing formula will reduce the share of federal government allocation from 15 to 10%. The share of state government will rise from 50 to 55%, while the share of local government will remain the same at 35%. But that is not the issue. The issue is the proposed changes on what state government should retain based on the derivation principle. Currently, the state retain 20% of the VAT they collect, while the population distributes 30%, and 50% is shared equally among all states. But the proposal increased the derivation allocation for state from 20 to 60%. This makes collection location as important as revenue size, potentially favoring high producing states. The administrators argue that implementing the derivation principle to share VAT revenue will be beneficial, but they overlook a better proposition, the destination principle. This is the engine block of the reform. As we know, you cannot drive a vehicle if the engine is defective. On one hand, the derivation principle allocation tax revenue based on where the tax is collected or derived. This means the state government collecting VAT will retain a portion of that revenue. This approach benefits registered companies in areas like Lagos, Rivers, Ogun, and Abuja. They will get 60% of the tax revenue regardless of where their commercial activities is conducted. On the other hand, the destination principle allocates tax revenue to the location where goods or services are ultimately consumed, regardless of where they are produced or sold. If a Sokoto man buys Dangote cement to build in Sokoto, his tax should be retained in Sokoto, not in Lagos, where the company is registered. Allocating VAT to the consumer areas will bring the expected balance in fiscal benefit. This will be a fairer and more sustainable way to distribute tax revenue.